Hello and welcome to the CNBC-TV18's Mumbai newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh. As always, you're watching Mutual Fund Corner. Today we are going to discuss an interesting report which is by Anand Rathi Wealth. It is on the Indian household assets. On one hand, assets of Indian households are on the rise, and on the other, equity mutual funds, they continue to see more flows. Actually, in terms of flows, I mean the rise in assets there. More than equities also is the interest that we are seeing here. In between all this data and more analysis, we have the guest with us in the studio itself. So, Pavitra, lots to discuss today.
Oh, absolutely. We have with us Feroze Azeez, who is Deputy CEO at Anand Rathi Wealth. Feroze, as always, thank you for coming down to our studios. It's great to speak with you again. Like Sonal was mentioning, you've done an in-depth study on the gross assets of Indian households. So just take us through some of the key takeaways and then we'll really get into it.
Also, firstly, this report of trying to see what does India own as a group of households could have some numbers with a tolerance of 5-7%. So we have 653 lakh crores as the current household savings. 10 years back, it was about 269, which is in 2012. 269 lakh crores. So what's one thing which can clearly be established with this data is we are great savers, right? Naturally, 269 lakh crores going to 653 lakh crores. So we are great savers. Second is we are not great investors, because if you look at how India's return has fared over the last 10 years with approximations of how much direct equity has given, how much equity mutual funds has given, as an aggregate, it worked out to be 6.8% only. That means India households have made lesser money than the GSEC, or almost equal to the GSEC. If you compare that with a US kind of an economy, where the 10-year GSEC for the last 10 years has been 1.5% average, but in US households are making 4%, 5%. So they're making 3 times more than the corresponding risk-free, and Indians are making just equal to risk-free. That's the second learning. The third important bit is the love for physical assets doesn't seem to be going down. We speak so much of financialization, but the percentage change has been just 2% favoring financial assets. So we are today at 51. We were at 52, 53. So the physical assets have just come down. Could be the cash economy which supports physical assets like gold and real estate could be the reason why that love doesn't seem to be fading in spite of financialization at the peak. These are the prima facie observations.
Those are interesting ones, right? The big surge that we've seen, and the next question was actually going to be on assets which go to financial assets versus the physical assets. As you pointed out, it's just been a 2% increase from 47% to 49% in last 10 years. Is it something that a person who looks at such a big money worrying for you? Should this trend change? Are you seeing that trend change as well? Because you said, you know, that cash love is going into real estate. We are seeing that go into gold as well. Is it changing at a faster pace?
It's a great question, because as a stakeholder like media or a distributor, the most important thing is India making money, right? Then the whole purpose of doing a show, doing education, all that results in an increase in return. So one point is the compounding impact on physical assets is very low. Everybody hears Warren Buffett and says eighth wonder of the world, but it works on equity like magic. On real estate, it doesn't. So and I can substantiate with data. Very over the last couple of months, we've analyzed 212 properties owned by 93 individuals, held for 9.83 years, and the compounded return is 8.84. This is reality, and the holding period is 10 years. If compounding worked, then the returns would not be so abysmal. That's point one. Point two, now we as India, we want to be the third largest economy. That's what IMF predicts in 2027 will be the third largest economy. So do households have to also learn, not just the government and the private sector? HNIs globally have only 16 to 17% in real estate. Okay, either they're doing something wrong or we're doing something wrong. So that's one second piece of information. Third, I personally think that from a real estate standpoint, the kind of relevance at a stage in life, see, if I have real estate, the kind of consumption it uses of my mind share, negotiate with the tenant, go to the sub-registrar, make sure that the property tax is paid on time. If I am an HNI, for sure, at 50, 55, 60, I would not have real estate because it consumes my time, and time is the only resource. So coming back to your point, will this change dramatically over the next 10 years? To me, I think so. Because education is taking momentum. Yeah. Second, we have become a very digitized economy, right? Even a panwala is currently taking a Paytm. That was not the case 10 years back. So the next 10 years could be a paradigm shift.
Okay, that's very interesting. And you know, you were just talking about how compounding works wonders in equity. But equity still continues to be such a small part, right? If you look at the overall pie, so why do you think that is happening? Why do you think that it has not got that kind of interest? And how do you think, say, the next 10 years will be from here?
Yeah, I think MF percentages are very low. As a total, it's just about 3-4%. Even as a financial assets, it's just about 6%. If both such great anchors keep doing MF corner, that proportion will surely go up in the next 10 years. But coming on a serious note, I personally believe that the chronology is not correctly defined. An investor who comes in, right, should first start with a mutual fund, then go to direct equity, and then go to derivative. Could be. That's the chronological order.
Here you get in with derivatives.
People are getting in with derivatives. I met somebody who says, I'm doing derivatives. So if you can just, as an educator or a stakeholder, as a SEBI, all of us put together, can just define the chronological order of your class 1, class 2, class 3, class 4. That's one. Second is, I think, expectations are not managed in equity. See, when we generally try to get a new investor on board, we speak of Sensex 3 lakhs, 2 lakhs. So he is coming with an expectation that I put my money and I'm going to double it. The expectation from equity is to 12 to 14% return, only if there are holding periods. And every year, equity shows a shock. That should be something which an investor, before putting even a rupee, should accept the fact that equity will show you volatility. And that's why it gives you 3 times more than an FD. I think that realization is not there to the new entrant, and then they're just mehman in this industry and they go back from capital markets.
Okay, it's interesting you say that, because when you said it's still a smaller percentage of the overall gross assets that Indian households have, mutual fund bit, equity mutual funds, in fact, they've seen an increase from 8.8 lakh crore rupees to 21.5 lakh crore rupees according to the report. Is this something that you're seeing grow from here on at a faster pace? Again, the same question. But what is the reason why people are more comfortable with equity mutual funds versus equities? Is that a trend here? And is it just for equities, or are we seeing it across different mutual fund categories?
So equity mutual funds, especially after COVID, people have become more educated.
Yeah.
Okay, of course, you've done a great job as a media house, but I can see a paradigm shift in their understanding. Earlier, when a direct equity guy gets hit by a market fall, like last year, 3 times market went from 18,000 to 15,000, 3 times. That time, people were moving from direct equity not to FDs. They were moving out of direct equity and getting into mutual funds. Otherwise, they used to be so naraz with equity that they would leave it forever.
Yeah.
They've got a little more educated. That's point 1. Point 2, I think equity mutual fund at 21.5 lakh crores, I'm not too happy as a participant, whatever small little participant in this industry, because it definitely quenches the thirst of growth for all AMCs, but does not dramatically change India's return. So if you flip the question, what should India have? Out of the 653 lakhs, it should at least have 1/3 in equity mutual funds. I have 60% of my money in equity mutual funds. Either I'm doing something wrong or the rest of them are doing something wrong. So we have to understand and correct that. So mutual fund industry is at a very, very nascent stage. And I think SIP numbers are speaking about its future growth.
Oh, absolutely. But it does show the promise of, picking up as well, right? Feroze, coming to, just the different asset classes, you were mentioning that for equity, expect a return of around 12 to 14%. It's not, you can't expect it to double. But that is for equities. Take us through what you expect for other asset classes as well.
Pavitra, if I can take a minute of what that logic is. See, equity markets depend on 3 variables. In the short term, they're news dependent. In the medium term, they are corporate earnings dependent. And in the long term, they are the environment, macroeconomic dependencies there. So in the next 6 months, what will happen will depend on the news flow. When I see an investor looking at a trader's opinion and marrying his strategy with that, because a trader needs to have a pucker on the news. Corporate earnings are going to be doing well. We had predicted the corporate earnings growth when during August in COVID 2020, we predicted that it will be the best year from an earnings standpoint. And today we have 774 growing to 820, and now we are looking at 936, and next year we're looking at 1048. as the earnings per share of Nifty. So if earnings are going to do well, over the next 5 years, Nifty will deliver median plus returns. Median returns of Nifty are 11. So if Nifty delivers 11-12%, active funds have the potential to deliver 13 to 14%, and I don't think it'll be unfair to expect that. Coming to your question of what you expect out of debt, to my mind, debt, you should not have corporate bonds currently. You should not even have state development loans because the spreads are at the least. If somebody is going to motivate me with 0.5% to lend money to a AAA corporate, I'd say I'll rather keep it simple and have Government of India paper of 7.2% rather than taking 7.7 with a corporate. 10 years is a long period. Anything can happen to any corporate. So it's not remunerative enough to take corporate bonds. So what can you expect out of debt? 7 to 7.25%. Now that there's a tax change in mutual fund, you might want to look at arbitrage funds, which can give you a better tax adjusted return. Real estate, residential real estate, 4-5% is what residential real estate can do in metros.
In terms of returns, despite the price hikes that we've been seeing, right? The delta is not much, as you've been pointing out, the study that you did as well. But you know, the interesting point that I noted from your previous answer, you said it should be 1/3 of the 653 lakh crore rupees that is there currently, which would mean around 220 lakh crore rupees, which is 10 times the current gross block in equity mutual funds. So what would a diversification strategy be for a person if you're saying that equity mutual funds are expected to give 14% return, say, down the line? Do you think then diversification makes sense, or one should put their money, all of it here, and then wait, since it's a time factor as well here?
I'll tell you how I see it as an investor. If you look at diversification, we are the largest number of listed stocks in the world. We have some 4,000 odd listed in NSE and 2,000 odd listed in 1,900 odd listed in BSE. So in the world, we have the largest number of listed stocks. In that, if a mutual fund industry is operating with 385 equity funds which are active and close to about 200 ETFs, optically it's not diversified. Equity mutual fund mein itne sare paise kaise dal diye? But it has the largest capital market in terms of number of stocks and close to 600 funds including ETFs. So I would not diversify further just for optical diversification. I can buy myself a PMS, I can buy myself an AIF, I can buy myself an NPS, I can buy myself several product categories which will make me quench my thirst of optical diversification. But I think equity mutual funds is diverse enough. What more than the largest capital market in terms of listed stocks?
Okay, that makes a lot of sense. Feroze, this has been a very interesting chat, but we have to take a short break, so we're going to do that. We'll be back in just a few minutes and we will continue our conversation with Feroze Azeez. Welcome back. You're still tuned into MF Corner here on CNBC-TV18, and we still have Feroze with us to talk about their study on Indian households. Feroze, insurance is still, you know, a big part of sort of the financial assets. What kind of returns are expected here, and what would you really advise someone who's looking at this space?
Insurance industry is one of the oldest from a productization standpoint, right? So I personally think there's enough data. We have analyzed some 3,000 insurance policies owned by several people and also attempted to surrender them after a good 10 years of holding period. The IRR was 3.03%. I'm not making a generic statement that all of them can make. This is just data which throws up. It's for anybody to infer what they infer could be the range of return. If that's the data of 3,000 policies, I can't infer saying that 8% ki return milegi, right? So guarantee sells in India. So a traditional plan can guarantee you less return than Government of India, but it still sells. Okay, that's a meaningless guarantee, right? If Government of India is guaranteeing 7.2, there's a product which I was reading an advertisement, when I calculated the IRR of the product, it was 6.7% guaranteed. So that's like lesser than. So I personally think insurance is a very, very important tool. Otherwise, personal finance can go for a complete haphazard way. So insurance term plans have become very commoditized, so that we should do. Health insurance has become far more important. Indian medical inflation is on the rise. We see vegetable prices on all that in CPI. But medical insurance is very mandatory because we computed the inflation in hospitalization and stuff. It's 17%. Okay, because a lot of Indians today are getting free insurance. So that's why hospitalization will continue to become very, very expensive in India.
Oh my God, that number is crazy. Okay, so 17% there, but of course it would be a good asset to keep, but not from an investment perspective. That's not something from a return perspective you would look at insurance, is what you're trying to say.
Ideally, math says that any good or at least decent distributor or advisor will say don't mix these two objectives. You will suboptimally achieve both of them.
Okay, all right. So what's your sense on, say, provident fund, pension schemes? Because this is what people look at from a lens of retirement schemes or small saving schemes. Do you think that's somewhere people should be diversifying when they make their entire portfolio?
Yes, I think that's one of the best debt instruments, right? Because from a taxation standpoint, not that the debt funds anymore have that lucrative long-term capital gain with indexation. So to answer your pointed questions, all these savings are great, especially clubbed with the second method of tax filing, the newer method, which is such a clean method. Your tax rates are not so high. Even if you are earning 15 lakh rupees in India, which is almost 7 times more than the per capita income of the country, the taxation is just 14% clean. If you compute using the new slabs, 14 to 15%. So these small savings schemes, which are actually taxable, not the PPF and the EPFs, are going to be far more attractive. If you have 2 people in the family or 4 people in the family, across different files, if you bought these, you can almost go scot-free without taxation.
Okay, that's very interesting. Feroze, we've spoken about a lot of these different asset classes and, ways in which you can invest. But take us through what a good portfolio allocation will look like. Is there anything that you would stay out of completely? What would you allocate higher to? If you can just break that up for us.
So, Pavitra, in my opinion, anybody who has money and who's or earning money in the future, first question they have to ask is, what's the money I need for the next 10 years? As long as you carve that out, there's so much more clarity with the rest of the money. So keeping it smudged can actually be detrimental. So first step is carve out that money which you may consume. If you're at the age of 50, 55, you may want to start consuming the wealth you've created. Then say that till I'm 65, I'm going to consume this money. Let's assume that it leaves him only with or her with just half the money. That half the money should be allocated at least 70-80% in equity. If you do that, of course, not a naked equity in terms of direct equity, because that's going to be 3 times more volatile than a mutual fund. So different age brackets, let me give you some suggestions. I'm leaving the physical assets for the moment. 10-year plus monies, 70% at least in real estate, 20 plus years monies, at least 80-90% in equity. Did I say real estate for that 70%?
Okay. I got that. I got that.
So 70% in equity, 20-year kind of monies, 80% in equity, 5 to 10 years, at least 50 to 60% in equity, and the rest of it in debt, because I've kept the physical assets separate.
Out of it, okay.
And in equity, all equity may be called equity, but the risks of different equity are very different. If I bought a PMS, I was just analyzing a PMS yesterday, which had somebody's 3 crores in it. But when I measured risk numerically, it was 2 times more riskier than a mutual fund, corresponding mutual fund. So, but it's still called equity. So you have to measure it.
I think we'll do a different discussion on that as well, different kind of equity investments that you can make. But last question, since we'll be talking about still a larger part going to physical assets, right? And gold, of course, is a big part here. Do you think that should still be the focus point for investors, or something like a sovereign gold bonds or gold funds are better to get better returns?
It's just an amazing asset class from a perspective of not spinning you return, but it has a great risk absorption capability, especially with the sovereign bond, gold bonds, taking away your transaction costs, taking away your GST, then gifting you 2.5% per annum, gifting you long-term capital gains 0. With all this, even if gold delivered 4% a year, you will be at 8-9% a year.
Yeah.
So you can't miss this lunch. Of course, they're limited in terms of per individual, but I think we Indians have large families.
And we sure know how to, take advantage of that. Feroze, it's been lovely having you on the show. Thank you for taking us through, that complete allocation strategy and what's happening across these different asset classes as well. But with that, we're going to wind down on this edition of MF Corner. Thank you guys very much for tuning in. We have closing bell after this short break.